Hello, Hayden here. Time to talk about an uncomfortable process and subject, but it's an important one, so let's dive right into it. Your debt to income ratio, often called your DTI, is a very important number that's used in the lending industry. And it's how a numbers-driven industry like the lending industry assigns a value to you, and it's uncomfortable. It's no fun going through this process. I've been through it myself, and it sucks because at the end of the day, even if you feel like you're good for a loan or for a certain amount of debt or a monthly debt payment, it doesn't really matter because at the end of the day, your debt to income ratio is often what's going to determine whether or not you get the green light to move forward with a loan. And it's an important thing to know. And I'm going to unpack it a little bit in this video and the next one to help arm you with more information and perspective on how to go through this process. So let's dive into it. So it's important and it's going to suck. And I have to tell you guys about the mindset that you need to have. You're going to be doing this a little bit. It's like watching a car accident for some people because you're going to have to unpack your debts and take a real, honest, hard look at your debts and how much qualified income you have, because those are ultimately the numerator and the denominator on your debt to income ratio. Your debt to income ratio is really important because it helps you qualify for home loans, auto loans. It even impacts your ability to apply for and qualify for a rental. If you want to rent somewhere and move in there, they want to make sure that you make enough money to cover that monthly payment. So what is your debt to income ratio? At its core, it's a simple math problem. It's not parabolas, it's not tangents, it's not cosine, it's not logarithms, it's not most of the things that we learned in school. And shout out to our education system for that, I suppose. But ultimately, it's a simple fraction. You got your debts on the top and you got your income on the bottom. Let's say your monthly debt payments are $2,000. You've got student loans, you've got a credit card payment, you've got an auto loan, you might have bought some new appliances or furniture, and all of those get added up together and they go in the top. So let's say that number is $2,000, and let's say that every month you have qualified income of $6,000. That would mean that you've got $2,000 up here, $6,000 down here, and your debt to income ratio is 33% or 0.33. That 0.33 number is what the underwriter is going to be looking at when they're analyzing your file, among many other things. It's a beast of a process, but that's what it is. And it's simple. It's not easy, but it's simple. In my next video, I'm going to break down how those numbers are calculated, what does and doesn't qualify as qualified income. And it's one of the most important. It's really that simple. And your debt to income ratio is that simple number. And it's a way to distill down a whole lot of inputs, various types of debt, various sources of income. And that's how you ultimately decide, or actually how a lender decides whether or not you can make the monthly payment. Because one of the mindset things you need to consider is that from their point of view, if you're getting a 30-year loan on a home, they don't want to know that you can make payments 1 through 10. They want to make sure that you can make payments 200 through 360, because you're going to make 360 payments over the course of a 30-year loan. And this is how they put their mind at ease, and their underwriters and their investors and the people that are putting up the money to help you buy a home or get a loan for anything. And it's important. It's just really, really important. And I don't want to say that word too much, but that's what it is. In my next video, I'm going to break down a few examples as well as adding some more perspective with regard to certain types of debt like credit cards and others, and certain types of debt that don't affect your debt to income ratio, and what types of income do count as qualified income. In conclusion, knowing your debt to income ratio, it's really important. It's an important part of knowing where you stand, what you can qualify for. And in my next video or the video after that, we'll break down how you take that number and back into what your budget is and how much loan you can qualify for and how much house or property or car or whatever it is you can afford. And it'll arm you with the information to be able to move forward more effectively, because once you have that number and you've calculated it yourself, you can more confidently get in touch with loan underwriters, loan officers, banks, mortgage lenders, and also make sure that you're making effective time of a real estate agent as well as your search, so that you don't wind up getting your heart broken. Because I can tell you it's not fun finding your dream house and knowing that you can make it work, but that the numbers don't work when it comes to getting your loan. So that's all for today. Looking forward to the next one. Thank you. If you enjoyed this content or you want to check out more, please like and subscribe and hit that notification bell. And until next time, I'm Hayden, and keep working hard, my friends. Peace.